I don't need to worry.
So
So
I guess we weren't broadcasting the main room, but now I think we are.
Yeah, are we?
I think so. We at least dropped the link there for the Wise Pub page, but I think we're live now.
All right. Okay, just want to make sure.
What's
Good
the
to
time
go?
frame for skew? Yeah, I mean it's 30-day implied volatility skew.
So 30-day implied volatility skew right through there, and that's so you're not looking at the 3 month. You're just looking at the difference in.
Yeah. And
And this is
normally, if you see the VIX at 21-22, skew should be down. The only problem is we're seeing that volatility is remaining stubbornly high, with skew also being high, which all that means is that the tendencies for the market to grind as the downside risks are being again that are just being expanding as we get higher and higher. We've created this vacuum, this pocket below the market that if it starts to sell, we could sell hard. So it's just
yeah.
be careful.
Yeah, just be really, really careful here and make sure that you know how to protect yourself. In the event we have a gap down or slippage or anything else that goes in the market, the ES and the futures might be trading higher, but we can also see these big red candles sometimes have fed into big gaps. And so when you see those big red candles, if you're just in the broad markets without a hedge, without a safety net, when it trades down and gaps down and gaps down like it did back here in August, that 10 to 14% decline, depending on which indexes you're in, that much of that was in the overnight trading. And same thing on the upside, we've had a lot of gaps up that are pushing prices higher in the overnight. Now, if you're long and bullish into the trades, you're great. You're happy with that. But if you're not, then that bearish move would be something that would be a threat to you.
And most sectors are underperforming the S&P. And so it's like, okay, where do I go to find some sort of alpha, right? Where do I go that I can outperform the market? And this is the pain trade, right? It's very difficult right now to outperform the market. The rotations are so fast. We're here, we're there, we're here, we're there. Okay, Nvidia's up, now it's down big, now it's up again. Again, it's been really hard to except for financials, really hard to kind of find that stability.
And that's what my next question would. How is it if the market is the market, which is made up of a bunch of sectors? How is it that there's no sectors outperforming the market? And that is because there's just one or two out of the 10 or 11, depending on how you want to count it. So you have just a few sectors pushing things higher, and that's what causes the S&P 500 to run hotter or run higher than pretty much everything else. That is rotation. We're liquidating all this weak stuff and rushing to the strong things. And I think that's really why it, in my view, is giving an opportunity to go into these next moves, these next big moves. And we are seeing that shift. We're seeing that shift into, like I said, the next move, which is currently financials, but it will likely push into bonds as we get more fearful. Right now, bonds are just getting discounted at these current levels. Now, I really like the idea of stepping into some dividend stocks. And the dividend stocks are one of those safety plays that you can look at.
Yeah.
Now, you were looking at a couple of those here.
Yeah. So yesterday during my session, I spent the hour, we talked about dividend aristocrats. I mean, these are companies, S&P 500 companies, large cap companies that have raised their dividend and paid a dividend for 25 years plus. So they have an amazing track record. The hard thing is the S&P right now is paying almost historically low dividend yield at 1.26%. The prior low before that was 2000 at 1%. So valuations are extreme right now. The dividend yields are low. But it's kind of interesting, though, that there's actually some stocks right now on the dividend aristocrats list. The two that we walked through yesterday was J&J and Chevron. The idea is one's paying 3%, one's paying over 4% yield, where valuations, they're not necessarily overvalued, they're not undervalued. They're probably about fairly valued in a pretty overvalued market, and they pay a stable dividend. They have good cash flows. And so, like, for example, J&J just had their earnings. They saw some positive revisions. And so we're looking at, probably about a 10% move upward in J&J in the coming months. with a 3% yield and a stock that generally outperforms the market during market corrections. And so the idea is that if you're setting up, but you're wanting to have some ownership, and even if you took that dividend of $1.20, you could even buy a put with the next dividend that's going to be go ex dividend in November. Buy a put for the near term, right? Just to cover like around that 160 level. And you've got some near term protection, a hedge if the market sells off over the course of the next month, which extends beyond the election. And you have a stock that pays a dividend, 3% yield, and some upside here as it may extend a bit above fair value given the most recent earnings release.
Yeah, and anytime like you can buy a put for less than the dividend you're going to get paid, out past the time you're going to get paid the dividend, I think it's a brilliant play in
And
these types of
it might be
stocks.
like 30, 40, 50 cents more, but that's not much to pay.
Well, you'll be able to sell it back.
Yeah.
Yeah. And it protects you, and you'll be able to sell it back. The other one he had is a CVX. So be aware, this chart that I just shared that Brandon gave to me, this 1.26%, the lowest dividend yield here. Remember, the markets and investors and institutions are looking for returns. And when we get a little sketchy on that yield curve or on that skew, they're saying, where's my best return? And if there's no returns, they're looking for these dividend aristocrats. They're looking for bonds because that's where you're going to get your best defined return without adding on risk when the volatility is high. And so this low is also assigned to you. You should be looking for dividend stocks. You should be looking at bonds for a potential bounce when we get to these record lows. Sorry, side note.
No, it's good because but the problem is that there's a lot of stocks right now, even dividend aristocrats, where the yields are low. The yields on these are at or above their 5-year average yield, which is a key component here. Now, Chevron, the forecast on earnings is expected to go down a little bit because they're expecting oil prices to go down. Well, if you know Blake and I, we're not expecting oil prices to go down a lot. And so all of a sudden you may have a stock that from an earnings standpoint could be an undervalued if oil prices start to tick higher here, and may have upside maybe upwards of 30% if oil prices start to rise back upwards again, and it pays a 4% yield, and it has very solid free cash flow that's able to meet or exceed the amount they're paying in dividends each year. So they're in a great position to maintain, if not grow their dividend or continue to grow their dividend. And so Chevron's another one of these names. If oil prices go higher, inflation continues to be a concern. Chevron should do well. Now, if we hit recession, oil prices, the bottom falls out of it because of demand. That's the other side of it. But again, similarly, you could buy like a 140 put for the next over a month into the end of November, be able to get past the ex-dividend date, and you can mostly pay for that with the upcoming dividend. I believe the ex-dividend date will be end of November.
Yeah, they don't. It's not. Yeah, Thinkorswim's not listing it yet, but it should be mid to end of November, and the dividend's at $1.63. It's a quarterly dividend. So
by the 4th week put options, and again, they're going to be around that dividend amount, maybe a little bit more, but not much.
Awesome. And this is the key. You're seeing the price to earnings ratio go higher and higher. You're getting dividend yields getting lower and lower. You're getting more of the flight to defense. And I wouldn't say flight to safety because we're just defending existing positions. We haven't gone into the movement yet. We're just simply saying, let's buy some more puts. Let's protect. Let's buy more insurance. And to me, I would say this is like saying, you know what? Rather than driving safer, I'm just going to buy more insurance and drive faster.
Yeah. And
I'm going to increase my coverage, and I'm going to never stop at a stoplight. And that's kind of what's going on right now. That the big institutions are just, rather than being safer and driving safer, they're just paying for more insurance. And that's all it is. And it's putting a lot of pressure on the markets, and those break free. And I know that there's sometimes that you think that we're always looking at this as the next big bearish move, and that we're always looking on the bearish side, but these are historic levels in the skew, historic levels in volatility, historic levels in inflation. And so you do need to be aware of these and be protecting against what could happen next. And as we set up these correctly, we're going to be able to see and be prepared for what could be the next wave, the next current, the next trend. Earnings season, this is just what missed yesterday. Procter & Gamble, Key, American Express, Schlumberger, First Third Bank, Regional Finance. These are just companies that missed earnings or revenues yesterday, every single one of those. And next week we have Google and MasterCard and Caterpillar and a whole bunch of other stocks. These are just the biggest players.
Yeah.
These are setting up, and we're seeing the pressure build into earnings, and we're seeing more red on those reports than what we saw before. Now, we also know that the banks outperform. That's why money is rushing to finance. But if we see weakness in American Express, that's your business finance. If we see weakness in Schlumberger or First Third Bank or Key Bank, your regional banks are struggling, even if your big boys are doing well. There's no lending going on. If there's no lending, there's no cash flow. If there's no cash flow, there's no life force in the small businesses.
Yeah, Don sent out an in-out spread on XLF yesterday. I really liked it. We went through it in my in-out mastermind last night, but yesterday afternoon there was some huge bearish trades in XLF early in the week, buying a 46 on a 44.50 in XLF. Again, these are probably a hedge, but it doesn't matter, right? It's just the timing of when they're putting on. We're just very, very extreme here in XLF. Makes sense that we might stall or drift. This is part of that whack-a-mole rotation where, okay, yeah, we're bidding financials right now, but all of a sudden financials start to come off. If technology can't pick up, market's going to go higher, or market's going to go lower.
And I thought it was interesting that we played the triangle and a channel almost perfectly to yesterday's close. To me, this is, you've run your course.
Yep.
So like the premium's good. You can trade it up, but it's also time to get out of trades or start looking to collect premium up at the top on those types of strategies. So, all right, we are down to the last couple of minutes here. I just wanted to throw these up here. A couple of the bullish and bearish things that we have going on in the market. AVGO, the gap up until it clears the high. I'm not trusting this. Broadcom is gapped up, and a lot of people saw a big move yesterday. I wanted to see it close higher. You can see that we kind of faded back down. So until we clear the high, I'm not leaning into it as much. I was setting it up earlier and it's like, well, it's got to close higher. So AVGO, I'm not as bullish as I was during the day. Nucor was really interesting move for me. We broke out of what I'd consider as inverted head and shoulders. And if gold is going to keep going higher, I like this breakout. I'm only a little concerned about earnings, but definitely a breakout type price pattern, and you have earnings coming up. Could be one that you'd play all the way back up to 166, but it really wouldn't surprise me to see 175 on the table.
Absolutely.
With Nucor. You're still long the US dollar and gold, and I think that feeds right into what we were just talking about there. Do you have a target on gold yet?
Yeah, so we're kind of hitting that at the moment. But we had it with a spread. We're looking at a 230. Forget the strikes, but yeah, I still think there's significant upside. There's some bullish trade this past week in gold. 255, 270 call vertical, 18,000 over 18,000 contracts on Wednesday. Again, I mean, they're still taking these bullish bets. We're going to see a big move in gold still. There's the threat. Recessionary pressures is going to cause the dollar to surge. But absent that, if we keep holding and the Fed's cutting, gold may continue to edge higher and outperform the S&P. But again, early in the week, there was a 29 November 255 sold at 270. And again, that's significant short-term upside if that comes to fruition. But again, the bias is still the upside in gold, though.
Yeah, I love it. Love the way it's looking. I've already talked about Baidu. Mo and Rio are interesting as well because you look at Mo, almost a breakout. I think the pressure is building for Mo to the downside, which normally I wouldn't be looking for bearish on Altria because I think it's more of a defensive stock. But this feels like it's building pressure, and I think we're going to probably see a miss in earnings. I'm looking for short positions all the way back down to 45, and I just forgot who I was going to look at. Rio. Rio's interesting to me as well because yes, it's a minor, but I just think this is a good representation of whether we see global demand in copper. The gap down close up yesterday. It's a non-US company. This is an Australian company. And if it fails at 65, I do think I can't drive 55, but I could drive to 60.
There we go.
Yeah, diamond one. There we go. I'm going to skip Halliburton. Schlumberger, we already talked about. These are some of the ones you were looking at before ELF,
Yeah.
UAL. You
Yeah.
still
So
like those?
UAL, I mean, UAL had great earnings, gapped up. But what you saw going into the strength on Wednesday, a lot of bearish option activity into that strength. But again, right now, yeah, probably holding off on shorting Jets and UAL. But you could look at even a in-out spread, bearish out spread, just saying, hey, we've just gone too far. Very similar to what we saw in financials as well. But yeah, it was interesting though that into the strength there was some bearish trade occurring into that strength as well.
All right, we are literally dialing it down to the last 30 seconds. Brandon, any parting words, anything that you're looking at going into today that we didn't get covered?
Yeah, no, I mean, really, what I want to see is that again, does gold continue to outperform the S&P? If it is, and with the dollar strength, the DXY strength, I mean, that is a bearish combination. If the market edge is higher, I want to see, does the VIX sell? So is it VIX selling that leads the S&P higher? But again, watching gold outperforming the S&P, and so again, that's not a bullish mixture going on if that does occur. And boy, if the VIX does decline today, where's skew going? You're not going to get it till after the close. Are we starting to eclipse 170, a new all-time high, just elevating those downside risks?
Yeah, and so what it comes down to is be safe, everybody. Whatever position you're taking, make sure you're not over leveraged into it. Make sure that you have some safeties in there, some safety, whether stop losses or long puts, something to protect you, because the big institutions, and as they say, the smart money is protecting themselves as well. So be careful. Keep your
Yeah,
powder dry, as the old adage goes.
yeah.
And have a fantastic Friday, everybody. We'll see you in the main room.
Have a great one, everyone.